Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing in that specific order. Today is Monday, November 18th, 2024. Today's episode starts with the weekly Daily Reminder Macro Monday. As an active investor, it's very easy to forget that these things are going on because these are not things that are being announced on the news day in and day out, but these are the things that are the most powerful and most important things going on. Despite what you might think about how certain politicians might do certain things, at the end of the day, the economy is bigger than that. I like to say on the show a lot of the time, it's not politics that runs the world, it's businesses. And this is what's going on with businesses and investment. And so these are the daily reminders, things that really should be taken into consideration strongly when making any current investment decisions, in my strong estimation. The first one being that the 2-year, 10-year Treasury yields were inverted for over 2 years. The last time this happened was directly before the Great Depression. When you have an inverted yield curve, it is screaming that the market people are betting enormous, unfathomable amounts of money on the fact that things are going to slow down. And the longer it stays inverted, the worse typically the recession or depression ends up being. And so 2 years is an extremely long time to have this inverted, and typically the recession actually starts once we get to a reverted state or an uninverted state between the 2-year and 10-year, which just happened in September. This typically happens because when the curve is inverted, it means the Fed is strangling the economy with both hands, saying, slow down, economy. We want to encourage you to save your money because we're going to pay you more money to save your money in a safe liquid account that, you're not locking your money in for any amount of time. You're getting the highest yield by just having basically cash, making money markets a very attractive place to be. And then once they've strangled the economy enough, the other piece to that is that it creates higher borrowing costs for people borrowing for shorter amounts of time as well. So what happens is when we uninvert, it means that the Fed is now lowering rates, saying, okay, we strangled it enough, we can see that it's slowing down. And then they unstrangle it, and then eventually, typically, for the past many cycles now, we've turned on the money printer to try to heat things up again, like has been happening in China for quite a while now. By the way, the U.S. tends to follow what happens economically in China, adding to the scariness as to what's going on. So just by itself, this first daily reminder, this is a huge signal that investors should probably be very cautious in markets. Second daily reminder, the SOM rule was triggered in July of 2024. Unemployment is still relatively low, but it rose recently at a pace that suggests that we actually are already in a recession. This rule was triggered saying recession is here. Now, with these two things, you would say, oh, well, the market must be scared. Well, if you're following markets at all, you know that they're not. The S&P 500 is currently priced at a PE ratio of 30 and a CAPE ratio of 37. These are historically expensive prices without even seeing much earnings contraction. Sometimes you can get earnings contraction to drive the price related to the earnings to go so much higher, but actually it's just the price that's gone up without the earnings. And so if we don't see explosive earnings growth moving forward, the current price is completely ridiculous, as the price is already at the point where it should be if earnings already are much higher than they are currently. looking at a 150-year history of the S&P 500 PE ratio, we can see that 30 is very expensive. This is the equivalent of paying $30 for a stock of stock worth earning $1. So you're paying $30 for $1 of return per year for these companies. Stocks can and often do get below 10. In fact, in 1980, it was at 6. In 1950, it was at 6. In 1917, it was around 6. So would you rather pay $6 for $1 of return every year, or $30 for $1 of return a year? And, this could potentially make sense if bond yields were, excessively low, but they're not. We're sitting around 4.5% yields still on the front end of the curve and on the long end of the curve right now. And so there's a huge mismatch between the price of bonds and stocks right now. Stocks are comparatively extremely overvalued. Let's say the price goes down from here and simply gets down to, a more normal level. I don't know what you've seen out there, but not everybody feels like they have a whole lot of purchasing power these days. And if they lose a lot of purchasing power, as is very probable when the stock market gets very overvalued, the slowing effect of the economy can snowball on itself very quickly. Things can get very out of hand. The Shiller PE ratio is also at 37 currently. Famously, this for a very long time was at its ultimate peak in 1929, right before the Great Depression, when you would not have seen the same price in the value of your stocks for 30 years. And that's not even accounting for the fact that there's inflation going on. And so just to feel like you broke even, you would have had to wait longer, something like 35 to 40 years. I'm going to say on this show that there is a high probability of that occurring again from where we are right now. And it includes the fact that for the first time, since stocks have generally gotten much more expensive, we've finally gotten to the point where we have a fear of inflation. Inflation was high, it's been sticky, and so we're going to have difficulty letting ourselves get into more fiscal debt and, pump the money printer on when inflation is not exactly down to 2% quite yet. Again, this Shiller PE ratio, it's a price-earnings ratio based on an average inflation-adjusted earnings from the previous 10 years. And we're sitting at a level very, very rarely seen in history. So unless somehow the form of investment of stocks has somehow become infinitely more valuable, it's pretty clear it's a bubble, actually. U.S. stocks, especially large cap, the big companies with enormous amounts of investment by investment funds, automatic investments, it's extremely expensive right now, making it extremely dangerous market. Next daily reminder, the rate cuts began very recently in September with a 50 basis point cut. The Fed was fearful then, although sounding more hawkish more recently. Now, with the 3-month 10-year yield curve still inverted, and the fact that the Fed has come out and said we do not want to see further weakness in the labor market, the Fed, because this is still inverted, the Fed is still restrictive. The Fed is still currently strangling the economy. For people that think that, we're in the cutting cycle, so the Fed is easing monetary policy, not exactly. They're strangling it a little bit less. That's it. And typically, by the way, the effect of the cuts don't typically really work for almost a year out. So with the first cut happening in September, you might not see the effect of that cut until the following September, which is a little ways out. And on top of that, when you have a situation where you have enormous fiscal deficits, it makes monetary policy less effective, both in the ability to raise rates and slow down the economy, as well as cut rates and speed up the economy. So if things are slowing down, it's unlikely that the Fed cutting, even if they cut very aggressively, it's actually unlikely that it will have enough of an effect to turn things back around. And this is why the crystal ball ratings remain. The S&P 500 is currently priced like a Ponzi scheme, relying solely on other people to bid up the price instead of having any kind of safe valuation. Contrary to how most people feel, when stocks are very low, that's when they are the safest. And when stocks are very high, that's when they're the most dangerous. It feels the absolute opposite, but that's the actual reality. My second crystal ball reading remains that there is a bear market imminent, and that the Fed won't cut fast enough to save the economy. And if they try, it will not be effective enough. The episode continues. Thank you for watching. If you enjoy the show, consider supporting with a like, or other means. Next item on the agenda, TLT. Still my favorite place to be. As you know, if you've been following the show, I hold about 55% of my own portfolio in various forms of long duration treasury bonds. From a charting perspective, we are still within this descending, broadening wedge at the bottom of a recent drop, suggesting pretty strongly that this is a reversal here. Very notably, when we have a lower low in price, we have a higher low in the RSI, a lower high in price, a higher high in the RSI, and also more recently looking like we're headed down in price still, while the RSI is actually still going up, suggesting that smart money is piling into TLT along with me, along with you and me maybe. Coming up tomorrow morning before the open, Walmart earnings will come out. Now, Walmart, as I've talked about on some previous shows, is currently priced just like the rest of the stock market, as if earnings are just going to explode higher forever. And, you know, what happens is when you have that much of a difference between the price and the earnings, what happens is that if the market doesn't get what they want, they don't get that humongous, earnings explosion, the speculative value of the stock will disappear very quickly. You can get shrinkage of markets very quickly down to more normal values, even if you have earnings growth, but the earnings growth isn't as strong as the market is predicting, as it's pricing right now. Also later this week, very probably most important thing going on this week is NVIDIA earnings, Wednesday after the close. If you've been following the show, you know I'm short semiconductors, the semiconductor industry. As I've said as well, as much as it sort of is a tech company, it's not selling iPhones. There's no wide moat here. Anyone can make semiconductors. And as soon as you have overproduction, their prices have to compete, which makes, the potential for, enormous earnings growth to not look so enormous anymore. I imagine a future where we may get to the point where the semiconductor industry will look like a lot like the car manufacturer industry, where you have companies regularly priced at PE ratios of as low as 5 because so many people are making so many of them. I mean, it was once a huge, expansive, booming market where everybody could make tons and tons of money, until we're making too many of them. Detroit, knows that story all too well. On to the charts. The S&P 500 going sideways a little bit here. I don't know what to make of this. Again, the 6,000 mark was hit. I'm not going to be surprised if this ends up being the top for as long as the next 30 years, to be perfectly honest. I wouldn't actually be surprised. You might be shocked to hear someone say that, but it's not out of the cards. It's just not out of the cards based on valuations, where we are in the business cycle, and everything else that I explained in the daily reminders. This is an extremely expensive and dangerous market, in my strong estimation. So obviously, my view of this says that the more probable direction is to the downside. But Mr. Market has done crazier things. Take a look at the Japanese stock market. I think it was going into 1980. If you want to see overvaluation in stocks, just because something's overvalued doesn't mean it can't keep becoming more overvalued. But, do I want to gamble on that? Well, not me. The next very, very important chart is the 10-year Treasury note. As everyone and their uncle has been pointing out, longer duration Treasury securities have been adding a lot of yield lately, and I've been trying to figure out where this is going to end. I still think that this is forming a top here. The longer this goes sideways, the more I'm convinced that this is forming a top. We still have, by the way, not had a close above the breakout candle of the purple line representing, I do this every show and I'm going to do it again, representing a huge, very long-term not double top, head and shoulders top on the 10-year note yield breaking, and we're basically testing this line. This line also lines up with the exact high of 10-year Treasury notes yields in March of 2021. The downside target, by the way, of this pattern playing out, if you take the top of the head to the neckline and put it where we broke the neckline, we would expect it to get to around 2.83% yield on the 10-year Treasury note, if not lower. Again, to zoom in on this, this is a very long-term chart, so it might be worth looking at on a weekly closing basis instead of a daily one. But for now, I'm going to stick to the daily, and we have not had a close, again, above November 6th's break above this trend line. So this suggests to me that this is like the ultimate fake out. I do believe very strongly smart money is pouring into Treasury securities right now. Moving along in the charts, DXY, the dollar index, as I've been talking about on various shows. Again, when we were around 100, everyone was saying we're going down to 80, and I said it looked like a bottom, and we ripped to the upside. Today, the dollar finally broke down a little bit. To my eye, this still looks very much in a bullish pattern. And from a purely technical viewpoint, I would think that this would be a buyable dip in the dollar index. The one thing giving me hesitance in this is that 107 in DXY is very high. It's an expensive dollar. While everybody is saying, the dollar's dead, the dollar's trash, and, you got to run to Bitcoin and these kinds of things that are highly speculative, the dollar is getting major bids here, which, again, globally is like kind of problematic when you consider the euro dollar system and how much international debt is denominated in dollars. A strong dollar can be a major leading indicator to weakness worldwide, not just in the US. So if this does continue higher ripping higher the way it has been, I believe we will see some major consequences of that coming in. This is the kind of thing that can trigger major black swan events, in the financial world, by the way. hugely important market to be paying attention to. One of my favorite chartists, Gareth Soloway, has been saying how the 10-year Treasury note yield has been going up, and it's what that is the market saying that inflation is coming or happening. I don't think that's what's going on. I think this is like a shakeout of all of the weak hands, honestly. But let's like forget the crystal ball rating and take a look at this chart. Again, the 10-year break-even inflation rate is still going exactly sideways. By the way, I don't know if you're as annoyed as I am to this new way they set up the charts on the Fred. You gotta do this weird like highlight thing. Anyway, the point is that since about beginning of October, while the 10-year yield has been going up and up and up, the 10-year break-even inflation rate has been going exactly sideways. So there's a huge argument here. There's a battle here as to whether inflation will keep going up or not. This market is undecided. It has settled at 2.3. So this is another hugely important market to be paying attention to. This is not like a little market. This is what people are betting the inflation rate to be for the next 10 years. And the participants in these markets are ginormous. This is ginormous amounts of money being put into this market, making it very important. I find it notable that the 10-year minus 2-year Treasury, the yield curve that I talked about in the daily reminders, how it was inverted, oddly, for 2 whole years. We've uninverted or reverted to a normal state, but we've been going sideways, sort of bumping along zero. We don't normally stay this close in yields. In a healthy, normal situation, you want to see the 10-year securely above the 2-year, not like meandering near zero. And then as of, it looks like this was updated, really? The 8th? Okay, I fixed it. Actually, it's as of Friday the 15th. So point is that we're still just we're not continuing to steepen in this market, suggesting that there is a potential to re-invert. And if we do, that would suggest to me that this recession or depression may not start for a longer time, but it will actually be worse than it would have been otherwise if this had just stayed where it is now. So I see inverted yield curves as sort of building pressure for worse things coming. Speaking of worse things coming and a slowdown, oil bouncing off of this trend line again. I find this a very, 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 very notable trend line going back to April of 2021. WTI crude oil bumping down against this line many times, and then more recently forming this is looking like a pretty clear head and shoulders pattern. Even though it's not at the top of the market, it's still head and shoulders. And then just bouncing off of it today. I said on Friday's show, like, is this it? Are we cracking down through on Monday? Obviously this line, it's support until it's not. The one thing that we can see for sure is that oil's not going to the moon. It's bumping along at what it thinks is a bottom right now, which tells me that, there might be a much lower bottom coming, perhaps very, very soon when I, use the technicals here in my crystal ball. The next chart, wood, forming a perfect head and shoulders top, one of my favorite leading indicators, because it says to me what, wood is priced at. It's what people are willing to pay for wood, which is what people use to build houses or add to their houses, fix their houses. What's the demand here? And we had this head and shoulders top, which is, this is a formidable, highly probable pattern to play out the way it normally does, which is the top of the head to the neck. Once we break down, we broke through it and then we retested it. So today was the retest. So the question is do we get a confirmation candle above today's candle saying that no, this head and shoulders pattern is over, or do we go to the downside? And if we do get rejected to the downside, the target on this would be all the way down at 73. Again, this being sort of a leading indicator, can drag other markets down with it. With Nvidia's earnings coming out on Wednesday, SMH, the semiconductor ETF, still within all of these, I know there's a lot of lines here to look at, but basically you have a head and shoulders right here, which we broke through to the downside. We also have this ascending wedge, which we broke strongly down to the downside out of. These are two patterns lined up with each other, showing a lot of weakness, a lot of bearishness. And this is all within the context of being at all-time highs in the semiconductor industry, with a left shoulder with a giant engulfing candle sending it down to the neckline, a white whale double engulfing candle at the head sending it down to the neckline, and it was October 15th where we had that final big, powerful, formidable engulfing candle, engulfing 1, 2, 3, 4, 5, something like 6 trading days. Still not fully playing out to the downside. This all spells out to me, along with, as I mentioned earlier in the show, my overall view in the semiconductor industry is being just like way too optimistic as far as how much money these companies can make. Again, it's not about how much they can sell and produce, it's about the profits. And so when you have enough production, prices go down, forcing profits to go down, forcing earnings to go down, forcing the valuation of these companies to not look like they're going to be worth an infinite amount of money going forward into the future. Again, trees grow very, very tall, and they don't grow forever. And we're talking about the height of trees and how that relates to the price of industries. Last chart of the day, Bitcoin having maybe its final hurrah. I mean, again, I really hope for everyone out there that is holding Bitcoin right now or purchasing Bitcoin right now at this price at 91,000. I really hope that someone tomorrow will pay you more money for your Bitcoin than you paid for it today, because that's what you're relying on. That's what you're hoping. You're hoping to get more dollars out of your Bitcoin. No one wants Bitcoin. No one wants Bitcoin. People want dollars. Granted, Bitcoin has gotten people a lot more dollars because they kept finding somebody to buy it for more dollars than they bought it for so far. And that can continue. That can continue for quite a while. But for me, it's extreme speculation and functions, largely like a Ponzi scheme. It's not completely a Ponzi scheme. On the other side, to play devil's advocate, it does have its use. People can, however you want to see it, for good or for bad, they can hide money in it. They can hide it from governments, and they do. You can transfer an enormous amount of wealth under the radar using Bitcoin, and which makes me surprised at how we haven't seen very many government crackdowns on it, not yet anyway. That combined with the fact that it only costs, like I found out recently, something like $1,000 to mine a Bitcoin in Iran, of all places. Be great to have a Bitcoin miner over there paying $1,000 to mine a Bitcoin and then selling it for $91,000. That must be very profitable for them over there in Iran. But I digress. From a chart standpoint, this is a bull flag. There's no other way to put it. Seems like people might continue to bid the price of it higher. I don't consider this to be value investing, which, at the end of the day, that's what my primary strategy is. I like to buy stuff that seems excessively cheap, and I don't like chasing momentum higher, as profitable as that can sometimes be. And that's all for me, my crystal ball. I hope you enjoyed today's episode, and we'll see you next time. Robschild.